Correspondent banks, you have none of those. A rep office, again, subject to, it's like domestic. Foreign branch, you're not subject to Fed Reserve requirements, but there's no FDIC insurance either. So if you're a U.S. person or corporation that has a deposit in Turkish branch of JP Morgan, if those guys default, you're on your own. There may be an insurance through the local banking regulations, but that's about it. Subsidiary is pretty much the same, but that's a separate legal entity. And the rest are similar to rep office, foreign branches. Now, let's talk about the capital adequacy standards. You guys know what's the principal business of a bank? How would you summarize what banks do as a business? What's the principal source of income for banks? How do they make their money? They loan money, but they loan whose money? They have some of their own money, but they basically borrow from other people, lend it to other people, and they make a spread. They hope to make a spread between the two. That's how they make their money. At any point in time, typically, even at a healthy bank, for every $1 of their own money, they're lending $6 or $7 of other people's money. Okay? So if there is some sort of a run on that bank, it is not that difficult for that bank to go down if there is a significant run. Why? Because a lot of the money that they lend is at somewhat illiquid long-term assets. You know, if you lend to a corporation for 5 years, and suddenly your depositors are asking for their money, you can call the loan back, but whether or not that company can pay it back on demand is a different issue. You guys remember what happened to Silicon Valley Bank last year, right? There was a big run on the deposits. I mean, that was kind of their fault. About 80+% of their deposits were not FDIC insured. They were corporate deposits. And as soon as people started thinking that these guys are not in good shape, there was a big run. They had some liquid assets, but they were losing money on those treasury bonds, and they were pretty much taken over by Fed. The only reason that thing didn't become a systemic problem, Fed backstopped all the deposits. And they basically said, okay, you know, if you want to take your money, they're going to pay it back, whether it's insured or not. That's why we have capital adequacy standards. Now, the way this works, there are some minimum capital requirements, okay? And the definition is pretty much fluid over time, but roughly it means your own money plus the money that you don't have to pay back very quickly. It's called Tier 2 capital. Should be, it varies from country to country, at least 8%, sometimes up to 12% of your total assets. So if there's a run on the bank, you should be able to pay your depositors. The second pillar, you need a supervisory review process. At any point in time, your regulators should be able to figure out exactly what's going on in your bank. Because if you wait for just audited financial statements, they are every 3 months. In banking industry, you can go down in one night. It's relatively quick, and typically the banks that actually go down within a week or so. So you need very active and effective supervisory process. You also need market discipline. Anytime a bank is not doing well, that's going to show up, A, in their stock prices, and B, in their credit rating. There's an international standard, it's called Basel, named after a little city in Switzerland. Come to think of it, there aren't too many large cities in Switzerland. This was the third version. It is designed to strengthen the regulatory capital framework, increase the quality of bank capital. Back in 90s, if you held borrowing instruments of your local government, that actually didn't count against you. It wasn't considered risky. The loans that you made to corporations were considered risky. So you could have actually hidden a lot of the risk. And when I worked in the derivative desk in London, we actually created structures that went around these regulatory issues. For example, back in the days, Turkish Central Bank had a limit on how much short position you could have on US dollar against Turkish lira. These are bets that says on a interest adjusted basis, you're going to earn more by holding Turkish lira compared to US dollars. So a lot of banks actually borrowed in US dollars, invested them into Turkish lira assets, and hoping that depreciation on the lira is not going to be as high as the interest rate on Turkish securities. They were actually making quite a bit of money. The trouble is, that's a lot of risk. In countries like Turkey, exchange rate depreciation typically happens quickly and at big amounts. 3 years ago, Turkish lira was trading around 6 lira to $1. It's now 27. That means currency lost more than 75% of its value compared to 3 years ago. So it happens quickly and fast, quickly and big amount. Of course, as a regulator of these banks, Turkish Central Bank was concerned that if you had too much short FX positions, you borrow foreign currency and invest it into Turkish lira assets, that's too risky. So they put a limit on how much you can do. We actually did deals that went around that. Here's a deal. Let me actually write this. We did a structured note issued by our means U.S. Investment Bank, subsidiary in Cayman Islands, as a U.S. dollar denominated bond. So since it's US dollar denominated, as far as Turkish Central Bank is concerned, This is a USD asset, hence is not subject to short FX position limit. But the payoff on the bond was indexed to USD TRY exchange rate. The lower is the value of TRY against USD, the lower the return. Sometimes as low as negative 50% on the bond. So for all intents and purposes, this is a security that is tantamount to shorting the foreign currency. If you borrowed foreign currency, invested into Turkish lira assets, and depreciation was low, you made a lot of money. But if depreciation was high, you lost a lot of money. This basically replicates that, but for regulatory purposes, it looked like it was US dollar assets. And I had two clients that were crazy about this product. I sold them a lot of it. Guess what happened? Both of those banks went down in 2000 crisis because they had so much actual short FX position. When Turkish lira depreciated overnight by 50%, they went bankrupt. Do I feel guilty? No. They knew exactly what they were doing. They were going to do it one way or the other. But this actually went around the regulatory limits. Nowadays, this is not possible because nowadays under Basel III, you actually look at the risk profile of the assets. That's why we have more stringent capital adequacy ratios. Okay. Let me stop here. We'll do the international money market starting Monday because we're gonna do that in detail. So we're gonna continue with chapter 11 on Monday. Hopefully with better attendance.